Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by LifeChamp that is titled Investor Psychology to Thrive in Any Market. So, welcome everyone. So, my name is Shen Chu. I'm the moderator for this webinar. So, in this session, we are going to look at what are some investor psychology. How do we manage this psychology so that we are able not just survive but thrive in any market condition? All right. So as usual, disclaimer, whatever we share on this webinar is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any securities should we mention here in this webinar. So if you decide to do any investment decisions, you are 100% responsible for your own risk, right? So allow me to briefly introduce our speaker, and he is none other than Mr. David Paul.
Hi,
now, David is a founder and managing director of Spiral Thinker Group, Sdn Bhd. So he graduated with a Bachelor of Engineering Electronics majoring in telecommunication from Multimedia University and built his career in the telco industry for the past 10 years. So fast forward, he wanted me to cut his profile short. So he's now a full-time investor and he provides value investing ideas and advanced portfolio strategies for high net worth individuals. He is often invited to speak at Bursa sessions, workshops, and webinars, and his professional comments and opinions on value investing are often featured in business publications like Focus Malaysia. So David, how are you?
Yeah, I'm good. Thank you. But I'm feeling slightly under the weather because of sore throat. So please excuse me if I do sound a little bit down tonight. But hopefully I'll try to be as clear as possible. Yeah.
No problem. You still sound perfect.
Thank you.
So take your time, speak slowly, okay? The rest of your throat, okay?
Can I have the screen, please?
Please, yes, go ahead.
All right. Thank you, Shane, for the very nice introduction. It's good to be back. But this is I think we live in very interesting times, right?
Indeed.
We are seeing asset classes across the board dropping like flies. I just learned earlier on that one of the cryptocurrency called Luna dropped more than 90%, in a couple of days, which is crazy, and it got me thinking because last time when we used to have these physical events and seminars, right? People used to come out to people like me, as well as my colleagues, as well as my business associates doing the same thing, right? So wow, I really admire you guys being full-time investing, so much free time, Yeah, I mean, when times are good, right? Yeah, you can say that, but when market is like this, right? It's not really easy, to tread through this volatility, yeah. But anyhow, this is a great time, so since the market is so bad, I mean, so volatile and so uncertain out there, right? It is the best time for us to sit back, relax, instead of trading, spending our time on trading, right? Spend more time to educate ourselves, read more reports, read more these analyst reports or company reports, industry reports. Keep thinking, going back to your drawing board, go through your lessons, strengthen your mindset, okay? And this is the objective of this seminar tonight. All right, this is not a new topic. We've been talking about this before, but I believe both Shane and I believe that this is a topic that cannot be ignored by any investor of any class, of any experience, right? Because as I will be showing you throughout this 1.5 hour seminar, that investors, your psychology and your mindset plays a very important role in your success in investing, in thriving in any market. But of course, probably I do have a confession that this topic, the title of this topic is designed in such a way to grab your attention. Please do not think or oversimplify that as long as you have a strong mindset, right, you're going to thrive in any market. No, right? That is only one of the factors. There are a lot of factors to consider as well, including doing your homework and your due diligence. But anyhow, tonight we're going to focus solely on the investor psychology and mindset. Okay, and as usual, I normally split my session into a couple of subtopics. So we're going to start off with differentiating the mindsets of traders and investors. Very important. I'm not here to judge. I'm not here to say which is better than the other, but whether you're a trader or investors, right, you can still thrive in the market, but you've got to have you've got to know which one you are, which group you belong to, so that you know what kind of mindset that you need to have in order to thrive. Okay, then I'm going to talk a little bit about short-term versus long-term strategies. I'm not going to spend too much time here, but instead I'm going to talk more. I'm going to spend a little more time, including practical experiences, case studies, mostly for myself, all my mistakes that I've done before. When we talk about the third, we'll talk about the art of managing losses as well as winners. Okay, and last but not least, I do have a couple of portfolio execution case studies for your reference. Okay, so sit back, relax, and try to enjoy tonight, right? I know it's a dry topic, but trust me, this is very important, and I'll do my best to make it as interesting as possible for you guys. Okay, let's start. Now, before I continue, again, I like to borrow some of the golden phrase from one of my investment idol. His name is Benjamin Graham, the father of value investing. He wrote this book called The Intelligent Investor. You should be able to see it in any bookstores out there. It is a little red book, all right, not very thick and not very expensive. I do recommend you to read this. Now, in page 23 of his book, right, he mentioned something very interesting, and which is actually it drives the gist of the idea of what I'm trying to deliver tonight, right? Benjamin Graham said in his book that investors' chief problem, and perhaps even his worst enemy, is likely to be himself, not the market, not the stock, right? It's likely to be from him, from within. All right. He added that the fault, dear investor, is not in our stars. Don't blame the stars. Don't blame your luck. Not in our stocks, but in ourselves. So, to be a successful investor, you need to have a certain mindset as well as psychology built. In a way, a lot of internal strength, because not everyone is cut out to be investors. I have to admit this. All right. So in my line of work, I do see a lot of people who are very loss averse, who can't even stand to see something red in the portfolio, and so on and so forth. So not everyone is cut out to be. All right. So with this in mind, right, you should set the stage for what I'm going to talk about tonight. And I'm going to start with the mindsets of traders and investors. This slide I used before, but it's a very, very insightful slide. Okay, so basically, I categorize the participants in the market as far as retail investors are concerned, like you and I. We belong to two very simple groups, whether we are trader or investor. Okay, so what are the difference now? A trader normally focus on the short-term narrative, all right, meaning short-term investment, short-term thesis, short-term positions, so on and so forth, right? Nothing wrong about it. I do know some people who make quite good money doing this kind of investment strategy, right? The time horizon can vary from anything from minutes to weeks. I do have a couple of Remiser friends on my Facebook who tend to, who like to share, what they make or what profit they make, right? Scalping on a daily basis. Okay, but I personally do not recommend this. It is actually a very taxing and a very stressful enterprise. Okay, traders normally emphasize on price and volume action. They don't really care about the fundamental as long as there is momentum, as long as there is price action, right? They'll go for it and they go for the kill. Normally they buy on extreme optimisms, meaning when the stock is hot, a lot of storage, a lot of people coming in, right? They'll tend to prefer this kind of stock because of the volume and the liquidity, right? Conversely, it also means that they do avoid extreme pessimism. Stocks that are, having a lot of bad news or bad, negative sentiments, right? They tend to avoid. They do practice the good ones, the good traders. They're very disciplined. They do practice very strict cut loss to limit their their risks. And unfortunately, this is to me, I view this as a disadvantage. Most of the traders that I know or out there, they do practice frequent switching of stocks. Now, this may work against them in the long run. Later, as I'll show later in the psychology section. Okay. Now, for investors, so I do this side by side for comparison. Normally, investors focus on the long-term thesis or the narrative, right? Doesn't mean that they'll buy. Investors only buy a whole. Investors can still trade, but they normally has a basket of stocks that they focus on to invest in the long term. Like myself, I do not have more than 20 stocks in my focus or in my purview. Sorry, in my view. At any point in time. In fact, I think if I were to count the number of stocks that I really made money on in a big way, that helped me make my fortune since I started, I think less than 10 fingers already. Okay, so investors tend to focus on long-term narrative. Time horizons, because of long-term focus, may be in weeks, months, or even years. Okay. I'm a very proud owner of Nestle. So I don't. This Nestle stock sits in my retirement portfolio. So I don't really look at it. I don't really trade. Every time I have extra money, right, I just buy 100 or 200 stocks, right. But no, this is not a recommendation to buy Nestle. Okay. Now, investors emphasize a lot on fundamentals. We do, instead of buy on extreme optimism, we tend to start selling at extreme optimism. All right. So I know that this is something that the traders will frown upon and say, why do you want to sell now? You can make so much more. It's basically different objective, different angles. Now, so instead of doing cut loss, we actually manage our risks usually by allocation. And instead of switching, right, we tend to be more focused. There are two schools of thoughts. You can either have a very focused portfolio, or you have a very diversified portfolio. But personally, I am the believer of a focused portfolio. So the downside of that is sometimes my portfolio returns can swing quite widely in a span of weeks to months. Okay, so ask yourself, which one of these are you, or would you like to be, or is more suitable for you? There is no right or wrong here. All right, every one of us here are just retail participants in the stock market. There are ways to make money from both camps, but for myself, I am a long-term investor. I tend to seek value. But these days, especially since the pandemic, right, we are trading through unprecedented times in investment. So me and my friends, me and my group of investors, in my company, we do tend to pay a little bit of attention on the timing these days, right? Because you can't ignore maybe sometimes about the macro, especially the general market sentiment, right? So these are the differences. Ask yourself which one you want to be, and it is very important for you to identify, because each of these two different groups of market participants will entail different strategies, best practice strategies. All right, so let's move on. Okay, now I'm sure a lot of you have seen this already, so I'm not going to spend too much time. I call this the roller coaster of emotions. Okay, this is what I went through last time as well, especially when I first started out. How many of you out there, right? After you buy a stock, right, you only to see the stock price tank. It happens to almost all of us, right? And especially when you do not know what you are buying, right? You tend to go through this kind of roller coaster of emotions. Okay, you can Google this, you can easily find them. But I'm using this to explain to you the difference between, the stark difference between being a trader and investors. When you are traders, you find yourself a lot of times in this kind of position. Now, using just the same price action, okay, but from a different perspective entirely, from a perspective of an investor, it could be entirely different mindset. Okay, if you know what you're investing in, when the price stock price tanks, right? Assuming there's nothing structurally wrong with this company, it is actually there's more value. Value is emerging. In fact, at the current situation, right, there are a lot of stocks have actually returned to their price levels around just before the pandemic. So actually, a lot of companies we do see a lot of value emerging in a lot of the good companies that we are tracking. But it doesn't mean that now is the time for you to silent or all in, right? Because there is still an element of uncertainty, especially with geopolitics, but as well as our main concern, which is the inflationary regime now, which actually affects a lot of the valuation of the companies that we see. Okay, so different mindset, you can see price actions very differently as what I've shown here. Okay, now, and why is this so? Okay, so I'm going to spend maybe just a couple of minutes to talk about this. It's really just about how we are wired in our heads. Okay, now, humans being a high level being, all right, living on Earth, we tend to be more logical, right, because of the evolution of our brain. Okay, but undeniably, now, although it is undeniable that we are logical creatures, but at the end of the day, at the very core, at the very base of our human nature, right, we are still driven a lot by emotions, especially fear and greed in the context of the stock market. Even without the context of stock market, let's look at something very how to say, simple. Think of the last thing that you bought, preferably a big ticket item, whether it's a house or not, a bag, handbag, or a car, or a very fancy, item. Was it because you did your studies? This is something that you got to have because it does so and so and so, or is it because it is driven more by your emotions that you want this thing? Okay, now in the same regard, think of the last stock that you bought. Did you buy it based on logical assessment, based on logical due diligence, or is it due more on emotion? Especially times like this when it's so volatile and uncertain out there, right? Now, why is this so? A lot of us actually are driven by emotion, myself included. I'm no exception. Okay, because I'm still human, and especially being a full-time investors, right? You cannot escape the noises as well as the vicissitudes of the market, up and downs noises, the news flow every single day. So it's quite taxing, to tell the truth. But why is this so? Why are we still driven by our animal instincts? Okay, now I want to bring your attention to the evolution of our human head or human brain, right? You can see this. This is many thousand years ago. The humans, as we call Homo erectus, right? You see the structure of our head, right? And compared to the structure of the modern human now, the Homo sapiens, right? You can see that actually this part, actually the part on the top, right, actually is expanding. This is the part where our logical brain resides. But our limbic system, our more ancestral animal instinct, the part of the brain, right, it still very much exists. And this is important for mainly because of survival, as well as other functions. Okay, and when it comes to reaction to things, to events, right? Normally the limbic system or the emotions part will react first, then the logic part will come. Okay, so imagine, like, because it is so near to your central nervous system, right? The limbic system is actually nearer to your central nervous system compared to the other parts of the brain. So it's like a electrical circuit closer to the central unit, to the central to your sensors and the actuators, right? They tend to react faster. Then comes the logic. Now, how many times for you guys out there, right? Only after you click the buy button, you regret. Ayya, why did I buy this stock? Or you click the sell button, only say, why did I sell so long? I mean, why did I sell so soon? Okay. Again, most of the times our decisions are actually influenced by our emotional side of the our thinking process. Okay, so don't blame yourself, but there is a way for you to train. yourself to be more logical. Okay, it takes discipline, it takes years of practice. All right, so that's it. Nothing much to it. So I've given you the issue. I've given, outlined a very simple way of how we are wired. So how can we try to improve ourselves, right? And for that, actually, so this topic is very much related to this thing called behavioral economics, which is a term coined by a very famous economist. He is a Nobel laureate. His name is called Richard Taylor. He wrote the book Behavioral Economics, which actually spun off a lot of fields of studies related to this, related to finance, behavior, human behavior, as well as investments. And one of the books that I've read, thanks to one of my colleagues in my team who introduced me this book, is by Daniel Crosby. It's called The Behavioral Investor. It's a pretty interesting book. You can grab it, I think, from the local store. Not sure if it's available. I've got the ebook. But it's a pretty interesting read, right? So one of his theories is that the number of bad decisions that we can make is limitless. I truly agree with him in investment and as well as in life. But in especially when it comes to investments, right? He opined, Mr. Crosby opined that behavioral risk has one or more of the following 5 risk factors at its core. So I'm going to summarize for you guys tonight the 5 dimensions of behavioral risks. Okay, now don't worry, I'm not going to go through all this. You can take a snapshot of this now if you want. Then you can go and Google or go through deeper studies. But basically, our bad decisions or mistakes that we made, right, could easily stem from any of these 5 dimensions, whether it's related to our ego. All right, I think this is something that a lot of us can relate to. Whether it is related to information risk. Information risk refer to something like, for example, it could be related to incomplete or flawed data or information. Somebody fed you wrong information, or you interpreted certain data wrongly, that could lead to information risk. But there's another angle to information risk, especially when it comes to human mind contortion. And this is related to attention risk, okay? Especially when you're invested in a company and you make money and you're so damn proud of it, right? And this is where the ego kicks in as well, all right? Because of the way we are wired, we tend to, our mind, if it's not trained well, tend to see the things that we want to see, all right? I know this is something, this may be new to you, but this is definitely happens to almost everyone. Okay, this is again related, it could be related to this thing called the confirmation bias as well. We do want to see things, especially when you invest in a stock, you tend to want, a lot of us, myself included last time, I tend to only look for the good news or the information or data that strengthens my investment thesis. And the human side in me tend to ignore what could go wrong, and a lot of times to my own detriment. Okay, so this is a very important risk that we need to acknowledge as well as manage. Emotion risk is one of the most I would say potent risk of all, because most of the time we make loss. The reason why we went into losses is because of emotions. Okay, attention risk, as I mentioned before, it is the how to say, the behavior where we tend to evaluate certain information in relative terms. The psychologists call it the salience trump, or the prominence effect, right? In other words, I think they use this situation where they call it the low probability, high risk, or low probability, high scariness, like shark attack. Now, to us, shark attack is something very scary. But what is the probability of you being attacked by a shark? Unless you go into a part of the ocean that is full of sharks, right? But to be attacked by a shark, when you're swimming in the beach or by the sea, right, the risk is relatively low, the probability is relatively low, but the emotional impact, that and the attention that we subscribe to this kind of risk is very high, compared to something which is high probability but low risk. High probability but low scariness. like driving on the road. Now, do you know that driving on the road, the risk, the probability of getting into an accident, touch wood, is higher than getting attacked by a shark or even, accident in the sky. All right. So this is what they call attention risk. Now, conservation risk is something that, like human, a lot of us tend to prefer status quo to change. We tend to put more premium on the conserving certain things or certain situation. And when things change, when the situation change, when our investment thesis change, or the companies that we invest in change, or the management change, we tend to not take any actions because we have this thing called the conservation tendency. All right. And conservation risk also may also be related to this thing called the loss aversion, where we tend to prefer gain to losses. Meaning, I think a lot of you will go through this. You like to see green things in your portfolio, right? You like to see the green numbers instead of the red numbers, right? Red normally refers to losses, yeah. So these are the 5 dimensional behaviors. I'm pretty sure that if not all, most of, if not all, the mistakes that we make in the stock in investment will fall into some of these, not just one, probably a group of all these risks that I just shown here. Okay, so now after we identify the problem, how do we solve it or how do we mitigate it? Mr. Crosby, he postulate or he recommend this rule-based behavioral investing, or in short RBI, and he make it into 4 C's, right? Which is consistency, clarity, courageousness, as well as conviction. Now, so actually it's very simple. It's something that you and I can do. The only problem is when our emotion kicks in, or when our other behavioral, instincts kick in, right? It can really screw things up. And in order for us to execute this properly, we need to really have discipline. Okay. Now you need to be consistent. When we say consistent, means we got to be really, really hang our ego by the door. We need to execute our trades or our plan without emotion and without the loss aversion risks. Tendency and so on and so forth. We need to be clear what we want to do. So in order to attain clarity, we need to do our due diligence. Everything should be evidence-based, all right? Whether it is in terms of quantitative or qualitative analysis, this will give us clarity of what we want to do, which will actually amplify the consistency part, as well as support the next C, which is courageousness. Now, if let's say you have done your work and you're very sure that you've covered all bases, that things should be according to what you have analyzed or researched about, right? Then have the courage to really execute your plans. And to do this, right, you've got to really behave a little bit like robots already, without emotions. And we do have some tools that can automate, which I'll share a little bit later. And most of the times, when the market do not agree with your thesis or your investment narrative, you may need to go the contrarian route. Okay, and this, trust me, this is very hard to do, especially when the whole market is against, do not agree with your idea, right? You tend to doubt yourself. Okay, and that is why you need clarity and consistency. And last but not least, all right, you got to be you need conviction. And when we say conviction, it doesn't mean that you've got to be proud or hubris about it. You don't try not to look down or try not to criticize people who do not agree with your ideas. In fact, embrace criticism, because some out of 10 or 20 or 30 criticism, right, one of them may come true, right? And to help us mitigate this, we can actually practice a more diversified portfolio, okay? Or according to your character, you can also be a focus. I tend to be more focused, but in terms of the industry that we invest in, we tend to be more diversified. Okay, so that's the 4 C's that Mr. Crosby suggested, and this is what I have shared previously. in the earlier in last year's session on the psychology topic, right? So, but I'm going to introduce. I told Shane that this is very theoretical. Even up to now, some of the listeners tonight may not be able to relate well to this. So I told him that I want to change the structure a little bit. So I'm going to add in a new topic called, the 4 characters, the assassin, hunter, rabbit, connoisseur, as well as raider, which is more practical. I think a lot of us should be able to relate more. But before that, I want to talk about the differences between having short-term and long-term strategies, and this will actually help you really frame your mindset of what you are supposed to do in your investment journey. Okay. Again, I'm bringing Mr. Benjamin Graham back again. In the same book, page 477, he said that this is one of my favorite quotes. All right. He said that in the short run, the market is like a voting machine. When you, especially, in countries like Malaysia or during the last election in US, right? It's a very emotional election. I still remember the time, I think back in 2018, 5月变天, all right, when we have a change of government, right? Emotion was so at the height, right? Around that time. So the market behaves like a voting machine in the short term, all right? Telling which firms or which industries are popular, which are unpopular. But in the long run, right, the market will actually reach a certain type of equilibrium where it will behave more like a weighing machine, where the real substance of the business of the stock, right, should be reflected in the long-term share price trend. Okay, so this is what it means. Excuse me. All right, so a couple of examples. This is something that I've gone through personally. Okay, I'm not going to tell you the name of this stock for now, but basically, if you look at this historical price trend of the purple and the blue chart, they look similar, isn't it? Okay, so I think they are both happening in 2020 during the pandemic. This is where I started buying for the blue stock, and this is where I started buying for the purple stock, and this is where I started buying for the blue stock. Okay, now the intention again is actually my intention then was, okay, because this was a speculative stock pick, so I intended this for a short-term gain, right? Tell myself 20%, I jiao already, laughing all the way to the bank. And excuse me, whereas this I intended for the long term. Now, the commonality between these two stocks that I invested in 2020 was I did not do enough due diligence. I did not do enough homework, but I went in anyway. Okay, but thankfully I didn't went in big. So what happened was, okay, just remember, the blue position was meant to be short term, and the purple position was meant to be short term, and the blue position was meant to be long term. What happened was eventually the short term stock, the purple stock, which I was meant to be, a short term investor, just to aiming to profit 10-20%, right? I ended up becoming a long term investor. Okay, right. So eventually I cut loss. All right, again. My mistake, and this to me is nothing actually, because at least you recuperate back and then say, okay lah, just bite the bullet, right, and make mistake. But this one I'll always remember. Now I don't mind to tell what's the name of this stock. The blue stock is actually DNO. Back in 2020, we started excuse me. We started paying attention to this stock is because that time we were looking at EVs as well and LEDs. We believe that LEDs will be more practical and more useful in automotive. So we started looking at this company, but I did not do enough study yet, so I lack information. So I bought in at around, I think our average cost was about $1. We started buying at about 80 cents and $1, and by the time it reached 180, we started selling. And by the time it reached $2, we saw everything, and we never looked back. Why? Because number one, to be fair, in 2020, we were focusing a lot on gloves. All right. So we didn't have much room to maneuver or much resources to look into other industry. We only really look into tech again back in 2021, but this was in 2020. So after selling the stock, it retraced, or very happy, made the right decision. But after that, see what happened? Boom! It went all the way to $5. In fact, it went even higher last year. Okay, so this was really, really, really oxymoron for us. So again, this is something where I personally intended something to be short term or long term, and ended up totally different because I did not have the right mindset. By right, when something is wrong here, I should have cut. And here, I do not need to really to sell off everything because I told myself I'm a long-term investor. But somehow, I can't remember for sure whether it's my emotion or my doubts that crept into my investment execution, which clouded a lot of things, and this ended up to become mistakes like this. Okay, and so I come to realize that actually framing the mindset is very important, and a lot of people think that a lot of market participants believe that to be successful, you need to be good in stock picking. Right, I agree as well. That is a given. You need to be good in knowing how to analyze the companies that you want to invest in or the stocks that you want to trade in. But there is another soft angle that is equally, if not more important. So here, I present it this way. On the left side is more about the action, also the more tangible. The blue triangle is more about our internal processes as well as what we can do, and the green triangle is basically more on the actions. All right, now I believe that psychology, all right, plays a very important role. At least half of your success factor, all right, to be successful in investing. Psychology coupled with patience and discipline. All right, this forms the intangible part. Now, the tangible part is where you do your homework. All right. So on the stock picking side, you need to do your due diligence. You need to understand the company. All right. Then you need to assess, for example, what's the risk to reward ratio before you go in. Now, don't get me wrong. Sometimes you can spot a really great company, but the timing may not be right. The price may not be right because the risk to reward ratio may not be attractive enough, or it's not logical enough for you to make this trade on, for the investors to lock into this kind of position. That forms about 1/3 of the decision-making process. And for the portfolio execution side, actually allocation is very important in this process. In my own experience, a lot of times, either I lost a lot of money because I over allocate, or I didn't make enough money in one investment thesis because of under allocation. That to me is very important. Okay, and last but not least, to achieve your alpha is how skillful you are in executing, and as well as how disciplined you are in following through your trading plan. Now, here is a very important word, trading plan. A lot of us went into a position, a trade, or an investment without any plan, and that is actually very detrimental towards your the outcome of your enterprise. So please have an investment plan or trading plan before you do anything. That will entail, all your due diligence, whether it's, if you're a trader, if you look at technical analysis, whether your position, you have covered all your risks and your bases. And if you are long-term investors and look at fundamentals, right, whether you have accesses all the necessary business angles before you make the trade. Okay, now, and I would like to point this out. Short-term strategies usually require a very steady emotional state. Okay, you've got to really have like a heart of steel, an impeccable trading plan, as well as discipline or laser sharp execution. Sorry guys, this is the reality. If you want to be successful in trading, you've got to have all these traits. Now, for the long-term investors, in my personal words, and as well as in my personal opinion, tend to be more forgiving, because we we are allowed to make we are allowed more room to make mistakes when it comes to the trading precision. Long-term strategies require what long-term strategies do demand from us is they require exceptional patience, all right, a sensible allocation or optimum allocation, as well as a very, very disciplined, if not mechanical execution, just like the trading as well. Okay. Excuse me. In terms of the tools that we can use, the traders normally rely on charting tools. And unfortunately, they do need to monitor the market or the stock price every now and then. And that comes with the job. Okay. For the investors, there are a lot of FA tools, including reports, including data that we can subscribe to these days to do our research. And then on the execution part, actually, our local brokers, I think most, if not all of them, should have things like automated trading mechanism, like good till date or good till cancel or anything. And this is very useful to actually discount the emotion from your execution. Right? Traders, short-term strategies have the tendency to accentuate short-term volatility, meaning they put more focus on the short, on the near-term ups and downs of the market, and a lot of them do undermine the long-term potential. Meaning, instead of holding on, longer for a good business or good stock, right, and realizing maybe say 100, 200, or 300% gain, they are okay with 20 or 30%. On the other hand, long-term investors have the tendency to dilute short-term volatility at their own detriment as well. I'm not saying that short-term volatility we can totally ignore, but the good investors, they are able to remain focused on the long-term objectives. So this is very important as well. Now, in my opinion, we can actually make use of these two things. For value investors investors like myself and my team, all right, we love volatility because this is where we can actually trade to reduce our costs, or trade to improve our alpha, or what we call over performance. But whatever we do, we remain focused on the long-term objective. For example, if we found that this is a great company, right, and it should have a multi-year growth, right, we tend to be long-term, but we will trade along the way, thanks to the volatility. Okay, so this is the differences between long-term and short-term strategies. Hope it can help you frame your mindset better to see whether you are a trader or long-term investors, right? This I believe should be quite useful for you. Right. Before I move on, actually, this is another case study, a real case study. I am invested in this stock. This is QES. All right. This is not an buy call. Right. I know the management personally. I like the founders. They are quite. They are actually very. They are very. They know what they're doing. They are engineers by training. So I tend to like what their philosophies as well as their way of thinking. So this is a case study where sometimes because we focus too much on the short-term volatility, that we may miss the long-term. So I call this missing out on the forest, on the long-term potential, for the trees, short-term volatility. Now, as you can see here, any stocks, whether it's good or bad, right, it tend to go up and down because of market action. Now, for example, this stock back in August, I think this one in 2020, it dropped more about 30%, in the span of few days. Sorry, you see, August, a few days only, half a month. All right. Now, people tend to panic. They tend to sell. Oh yeah, something went wrong. Even then, back in May, I think this was I can't remember the date, 2021, and yeah, correct. So this one as well, this one dropped about 20%. People start to panic. But imagine if you had sold, if let's say you're long-term investors and you got traded out, you got panicked and you clear your positions in this company, right? You may lose it for the long-term, potential. Now, this is taken from this part. This is taken from this part. Now, in the scheme of things, if you look at it in a long-term view, right, you can see that actually these are just very normal fluctuations of the stock price, regardless of the reasons behind. Okay, this is the nature of the stock market. This is the function of the stock market. Our job as an investor, all right, I'm speaking from my point of view, is to realize, is to look at the potential of this business and decide even to hold it, even invest it for long term. Now, don't get me wrong, traders can also benefit from this. knowing that this is a good company, right, and knowing that market goes up and down, they can actually take take advantage of the volatility to make quite a handsome profit along the way as well. Okay, so these are just some case studies which is close to my heart. Again, I want to stress this is not a buy call. Okay, right. Let's move on now to the more interesting part of this topic. Excuse me for a drink. Now we move on to the art of managing losses and winners. Now focus on the word art. This is not a science. All right, meaning there's no theories, there's no mathematical formulas, there's no hypothesis. It's just an art, which is coined by experienced investors out there, including myself, from my mistakes. Okay, but before I talk to you about my mistakes, I gloat to you about my mistakes. Again, I want to introduce the second book tonight, which is The Art of Execution. A very interesting book again. I highly recommend you to read. It is by Lee Freeman Shaw. Okay, basically what he does is I'll show you later what he did. Basically, I think in the span of 6 years, he gathered a lot of he was tracking a lot the performance as well as the actions of the famous fund managers. And then he tabulate their actions, their behaviors, as well as the performance in a structural, in a more scientific manner to see what are the traits which are good and what are the traits or the characters that we should avoid. Okay, now, so we know that when investing in properties, it's all about location, right? When it comes to equities investment or trading, it's really all about execution. Okay, he found out that as a summary of this project, right? He found out that normally it is not the best ideas, it's not the ideas of the best portfolio managers in the world that make them money, but how they execute on their ideas. That is why execution is very important. Whether you're executing from a trader's point of view or from a portfolio manager, long-term value investor's point of view, it's very important. And to make things complicated, interesting lah. It's actually humans are emotional beings, and this is why it is an art. It's not a science. And to make it worse, humans are emotional beings and thinking ones too. Meaning, when you mix emotion and logic together, right? Sometimes the effect can be really, how to say, mind blowing. Okay, so it comes to it made me came to this conclusion after reading this book, right? That in order for us to be successful in portfolio allocation, it's not just a function of the macro environment or how the external factors like the company, the company health or the stock price movement affects our execution. It is really a lot about the psychology, well-being, as well as our mindset. That is why before this, I stress a lot on the getting the right mindset, whether you're a trader or an investor. All right. I also talk about the psychology part, the different risks and so on. Okay. Why? Because I want to drive this idea, after reading so many books as well as from my experience, that really to be successful in executing your portfolio of investments, right, you need to take care of the external factors as well as your inner factors, how you are doing it, how your psychology being is, so on and so forth, right? This is very important. And as I mentioned before, Lee Freeman Shaw, he documented the findings of, not 6 years, but 7 years, from June 2006 to October 2013. Mind you, that this included the 2018 global financial crisis, where stocks crashed all around the world and rebounded after. All right, where 45 of the world's top investors were studied and all of the trades documented and analyzed. And why I like this book is because he didn't use very sophisticated, bombastic words to explain his findings. He used very simple, very relatable angles to actually deliver his findings. So he grouped these 45 investors, right? categorize them in how they react to their losing positions and their winning positions. Not whether they are winning as a portfolio manager or they are losing as a portfolio manager, but more on their position, not on their stocks, or the allocations that they hold. Okay, and he found that he can basically categorize all of them into 5 different characters. So for the losing positions, he actually characterized the group into 3 characters, which is the rabbit, the hunter, and the assassin. And when it comes to the winning positions or winning stocks, most of them are either raiders or connoisseurs. All right, excuse me. So I'll explain a little bit more after this. Now, I'm going to go through a very summarized definition of the different tribes, the 2 tribes of investors. Mr. Lee, Mr. Freeman grouped them into 2 categories, 2 tribes of investors, how they respond to losing and winning positions. I hope that you can pay attention to this, because along the way, I want you to ask yourself which one you belong to when you are taking losses or when you are actually riding your winning stocks, right? Okay, and it's very important. Now, the assassins, he found there are the people or the managers or the investors who deals promptly with and unemotionally with failures. Very good. Okay, and they tend to be able to move on without any regret. Wow, very good, huh? But there's a but here. Assassins often cut losses too quickly, too often, because they're scared. All right, and again, they sell their winners too early, just like what I did with DNO last time. Okay, and by right, I should be assassin as well when it comes to the first purple case study where I become a long-term investor, right? Okay, when it was meant to be a short-term. So assassins they can be very unemotional. All right, they can move on from the mistakes, which is good. But the downside is they tend to cut losses too often. And sometimes when you cut too many times, right, it really, really affects your portfolio returns. All right. And instead of riding their winners to the full potential or near to the full potential, they tend to sell the winners too quickly. Now, the hunters are somebody that I can really, really relate to, because this is how I used to be when I started being a little bit successful in my investment journey. Hunters tend to watch, analyze, and then at the right time add, all right, their positions. But a lot of times when the price comes down, right, they tend to average down in order to salvage the investment. Okay. Now, there's nothing wrong with this strategy. Okay, because when you average down, you are bringing down your price. We call it the ABC. In one of my portfolio sessions, I call it average balance cost. Now, the thing is to have conviction. Remember, one of the 4 C's, right, of the RBI strategy by Mr. Daniel Crosby is conviction. The hunters who do not have conviction in the investment, once the stock price goes back to their balance cost, they will sell. Oh, yeah, so happy that I didn't lose any money. Now, how many of us actually went through this process? Now, what the hunters should do is, it's good to average down. Make sure that there's nothing wrong with your investment or the companies that you invest in. Then let it ride. Let it ride. Let the market realize, discover its value over time. Okay, but a lot of hunters, including myself, last time I tend to cut my position, especially when the stock price goes back to my cost. All right, without really following the true potential of the stock or the company. Now, rabbits, unfortunately, is the worst of the characters. It's the most how to say kasian of the characters. All right, rabbits, they are more interested of being right than making money. All right, so which means that ego comes into play, and they can be very defensive as well. But when things goes wrong, just like a rabbit or just like a deer standing in front of an oncoming car, the headlights, right? They tend to just watch their investment or their positions fall and not doing anything about it. Why? Because they are paralyzed. Okay, whether it's because they didn't do enough homework, they didn't do due diligence, or they just got lost. They don't know whether they're investing for the long term or they're scalping for the short term. They don't know this. That's why they become paralyzed. There was a stalemate. All right. they didn't cut or didn't add like the hunter. So this is the most dangerous that you can be in the stock market, because this will really hurt your investment capital over the long run. Do this often enough, right? You can really wipe out your capital. Okay. Now on the winning tribe, excuse me, Mr. Mr. Freeman Shaw, he said that actually can characterize as a raider, which I use Indiana Jones here, as well as a connoisseur. Now, raiders are good managers who would snatch at any profit they make. But again, just like some of them, like the assassin, they tend to sell too soon. All right. Now, but the bad traits of a raider, all right, just like any hunting, treasure seekers, right? Treasure raiders, they can be bought very easily, and they love new adventures. Meaning what? In the context of investment, they tend to want to look for the next winner too often, without really focusing on their winners on hand, all right, or the companies that they hold on hand. They can be very impatient. They tend to be more present focused. Okay, if this doesn't work well, okay, cut, move on. All right. Now the thing is, if you do it too often enough, the loss cutting may really eat into your profits, or even eat into your capital. So this is something that the raiders can relate to. Now I'm sure even up to now, right, a lot of us can already identify ourselves in any of these four, or even more than one of these characters, right? Okay, so it's good for us to know first where our mistakes are, all right, and so that we can improve. Okay, now last but not least, the connoisseur. Connoisseur to me, according to Mr. Freeman Shaw, is actually the best, has the best characteristic, because the connoisseur, he believes, is not easily paralyzed by its losers, it's not easily swayed by market noises. They are able to adapt well to situation when losing, when the positions are losing, and they have tendency to let the winners run as well, holding for a long durations, even up to years. Okay, but the drawback is sometimes they do not know how to take profit, because they really believe in the story, right? And they may fall into the what you call conservation risk, or the other type of bias risks. Okay, where they do not want to take action, because they do not want to they do not admit that there are changes in the investment thesis or the companies that they invest in. So this can be detrimental for connoisseurs. All right, they can be very patient, but sometimes they can take profits too late as well. This happened to myself as well. I'm not saying I'm a connoisseur, but sometimes I do realize that I take profit too late, especially when things it's very certain that things are turning against on the downside already. Okay, so these are the five characters identified by Mr. Freeman Shaw according to his project, 7-year project. So, and the interesting thing here is, in his study, all the tribes make money in the long run, except for one, which is the rabbit. Okay, so whatever you do, all right, if there's a takeaway from tonight, right, be not the rabbit. Don't be the rabbit. All right, don't be the rabbit in investment. Okay, put your ego aside. All right, ask yourself what can go wrong. All right, and when things really hit, when shit hits the fan, right, just do the necessary to cut yourself off this cancer, I would call it. All right, so. And the worst combo to be, other than rabbit, is actually a rabbit and raider. Why? Because rabbit do not know how to cut loss, all right, or do not can be defensive, even if you're wrong, can be egotistical. Raiders tend to go in and out, adventure seeking, excitement seeking, right? That's like a roller coaster. Okay, so these two are the most dangerous combination. Now, I have met quite a few clients before, where, because some of my friends or clients, they actually came to us and say, hey, this is my portfolio, can you help me? And is don't be surprised that a lot of the stocks that they hold really is either some of them are delisted, or some of them it's already gone. It's a gone case, but they are still holding it. Why? Because they are a rabbit. Okay, they are rabbit in that sense. They don't know what to do. They're paralyzed. Whether cut loss, yeah, 2,000 shares only, man. Why should I cut loss? Just leave it be lah, you know. Okay, don't laugh. Actually, all right, because I do meet people like this. And how come they end up with so many stocks? This kind of what you call baggage in the portfolio. It's because along the journey they behave just like a raider. They like to switch stocks, frequent switching. They like to look how to say fish for the next multi baggers. All right, which can actually work against them. Okay, so whatever you do, avoid being a rabbit, and worst case scenario, avoid being a rabbit and raider combo. Okay, so knowing the different characteristics, right? Actually, there are certain things that we can do to actually improve ourselves. Now, if you think you are more like a hunter, like myself, in my early journey as an investor, before you engage into any trade or any investment, you have to make sure that you allow yourself a certain maximum allocation for each stock. Right? And then whatever you do, don't go above this allocation. Okay, and this will actually help you a lot. It is actually a virtue for you to be able to be insightful enough to actually average down, but make sure that you have a maximum allocation where it is when it's enough, is enough. Okay, that will really help you in actually improving your success rates. Now for the assassins, all right, it's good. You have actually the assassins have a lot of good characters, but assassins can actually improve their trading or their portfolio execution by exercising more due diligence, especially in the stock picking phase, and then more patience, especially in letting the profits run. Okay, so this is very important. For the rabbits, okay, now rabbits, whatever you do before you embark in your next investment project, right, you need to have at least a simple plan. And then after you have a plan, do look at my other webinars, especially in the portfolio construction. Construct a portfolio plan, then construct a plan how to execute. All right, and then follow through. Very important. And then along the way, put your ego aside. Always seek I call it the fifth thinker, the fifth thinking head. What can go wrong? Did I miss anything? All right, be humble. Seek opinion, seek criticism. All right, don't brush them away. All right, definitely don't be too defensive. Just listen. If you don't agree with it, just forget about them. All right, but sometimes people can tell you, people can show you what you have missing. All right, be humble and cut loss when your assessment is wrong. And this is very important improvement measures for the rabbits. For the raiders, instead of being too present focused, you can try to be more future focused. So instead of taking profits too early, as long as you are as long as you are investing in a good company with good growth, good outlook, right? Let the profits run. Okay, you can trade along the way to reduce your cost. That's a given. But you can also try to manage your adversity to losses, meaning try not to look at losses, especially paper losses, with too much weightage, because sometimes, most of the time, as long as your company is strong, outlook is good, right? It could be just a short-term risks. Okay. So other than that, so that's about it. All right. So these are the suggested improvement measures by Mr. Freeman Shaw. I'm sure there are more. After tonight, think about it. Which character that you identify to or relate to mostly. Okay. To tell the truth, in my experience, I can tell you, I used other than I don't think I'm a connoisseur at the moment, but I've been an assassin, I've been a hunter, I've been a rabbit, and I've been a raider as well. So after reading this book, it got me thinking, hey, actually, I should I should identify where my problems are, my problem areas are, and try to improve them and behave or execute my portfolio actions more like a connoisseur. All right. Okay. So this is basically what I want to share about the investment. I mean the tribes, how they respond to their winnings and their losses. Okay. Now, last but not least, I think I'm a little bit slipping time, but just give me about a couple more minutes to go through these simple case studies. What are the how you can actually execute your portfolio actions without any emotions. Okay, so these are my from my point of view. So it's not for any books. Okay, as well as from my mistakes last time. Now, to thrive as an investor in any market, right? The key, the success, in my own opinion, is to de-emphasize our ego and emotions and really automate our execution process. Of course, this is after the due diligence phase, as well as all the portfolio construction steps. Okay. Now, there are tools and steps to help us minimize our emotional stress or actually help us achieve our A game. All right. I cannot stress enough. You must start with a plan. You must start. This is just like any business, right? You must have a business plan. In investment, you must have an investment plan. Now, try to invest for the long term. Now, when I say invest for the long term, it doesn't mean that you can only buy and hold. No, absolutely not. Try to look for companies that can have long-term growth, they have long-term prospect, they have strong management that operate in the sector or economic sector that is green. When I say green means the growth should be a no-brainer. Okay, definitely don't go for sunsets. You can go for cyclicals, but you've got to be more careful with the timing. But at the end of the day, invest for the long term. Even at this moment in time, when the market is all volatile, right? My own retirement portfolio that I have, I'm still invested. In fact, I haven't really reduced my my exposure. I'm about 27% cash only. All right, in my own investment portfolio, because most of the stocks that I have in my retirement portfolio are very I call investment grade stocks, which do not really swing the price, so I can put them aside and focus on my other business aspects. Okay, focus on the business and not on the price. Focus on the management. Focus on the fundamentals. This is what I mean. Defocus on the price actions and noise. Now, that doesn't mean that you can totally ignore, or you can actually look at it to help you sharpen your timing skill a little bit, or to help you reduce your exposure, your risk, or your average, but whether it's by allocation, by weightage, or by your average balance cost. Okay, and the most importantly is avoid buying and selling everything in one go. You must have a plan, and you should execute according to the plan. Okay, now I do have a couple of webinars organized by LifeChamp as well as Busa on the LifeChamp's YouTube channel. You can go look at it. Some of them include essence of portfolio management as well as the science and of buying out of selling, which are related to this. Okay, now okay, I'm going to go through the case study number 1, which was meant to be a long-term capital gain. Again, the intention for this was actually do a 6% maximum allocation on this stock. So the total buy was about 270,000, slightly below the 6% maximum allocation mark. But because of a successful execution, I saw the stock at 280,000, which means, you see, when the sell value is higher than the buy value, which means it's higher than your cost, you make a profit. But in this case, I still have 60,000 shares left, which is valued at about 1% weightage of the portfolio. What does this mean? This means that other than this profit, the remaining 60,000 shares are actually free. Okay, but again, 1%, it doesn't really have much meat, because even if the stock were to double in the next year or two, the impact on the portfolio will only be 1%. If it's triple, it will only be 3%. So this does play an important part. Okay, but that's beside the point. Now, here, I look back and it, hey, actually quite behave like a connoisseur, all right, in this, because again, this is QES, not a buy call, all right, but just sharing with you how we executed this, okay? So these are the buy sell, the buy trade. So I share this with you just to show you that I did not make this up. Actually, this is a real trade, okay? We tend to sell when the share price goes up. All right, sometimes even in the short term, because the share price has gone up quite drastically in the short term, in the short period of time, we do tend to take action to reduce our costs. And then sometimes you may be asking, hey, David, if you sold here at about 50 cents, why did you buy back around here at 60, 70 cents? Why? Because here there are some fundamental shifts in the company when they announced the MOU with the JV with an American company that will actually help them open new markets to China, and then they also reported very strong results with great outlook in the future quarters. That prompted me to relook into this investment thesis and then add the position. But of course, I took the decision to reduce this weightage about this price. So we left with 60,000 shares, free shares at 1%. So this is one of the examples of how we can, how I managed to, be successful in the investment investment thesis, like a connoisseur. Now, the second case study is actually a loss. Is it meant to be short-term cyclical? Again, 6%. All right. So the total buy value was also about 270,000. But I sold at below cost at 239,000. So the loss making was 24,000, higher than the profit that I made earlier, right? All right. Balance quantity, no, mean I cut loss. All right. But here, what I'm proud of is I actually behave like assassin. Investment thesis is wrong, cut no matter what. All right, even you lost money. Why? Because you live to survive another day, look for another opportunity. Now, the reason why we cut loss, actually, this is Parrot Transit. Don't know why. For the life of me, I don't understand. This is one of the darling stocks among a lot of fund managers. Okay, we started buying at the peak, yeah, around this price here. Then when it came down, wow, think like a hunter. All right, average down. Then when they released its quarter results in March, again, I joined the live webinar because of, after the results were released, then I found something is wrong. Hey, my investment, my assessment into this company is totally wrong. So I decided, again, I did not cut it right away. It took me a few more days. All right. Even if I cut here, I would save 2.5 cents, but I cut 80 cents. So I lost about 24,000 in this position. But it's fine. I think because I own out to my mistake, so I move on from here. So I behave like an assassin here. So hopefully by sharing this, I can help you guys think about how you can better execute your trading or your portfolio plans in the market, especially in the volatile times like this. Okay. Now, as a conclusion, right? 2022, as we all know, it's likely going to be an unprecedented year where a lot of things that never happened before may happen. Okay. And trust me, the narrative, the storyline is far from being mature. Okay. So here, these are some of the risks and changes around the world that we are focusing on. Good news is we are moving into endemic. A lot of countries, a lot of markets are moving into this phase. We are also moving. A recovery is also taking shape. So that's good news. Digital transformation is actually as a result of the pandemic. It's actually good for technology as well. It's good because of the shortages, including labor, that forces all industries to go into automation. All right. But there is, I think we do see signs of wealth distribution across many economies. And unfortunately, international diplomacy right now is at its all-time low because of the geopolitical risks. We do see deglobalization of supply chain as a major risk because of the deteriorating diplomacy, international diplomacy. Everyone is scared right now. National security is the main issue. All right. And last but not least, our biggest concern is actually inflation, and we may be heading into a stagflation economy very soon as well. So with this, right, I just want to highlight that we advocate at times like this, a lot of patience. Also do a lot more studies before you embark into your next investment or your next trade. Okay. Just to wrap things up, these are what we shared. This is what we talk about tonight. Try to manage your emotional behavior driven by greed and fear and logic. Try to take a step back. All right. Let's say you are incentivized, or you tend, let's say you find yourself wanting to make an action, a trade, right? Maybe you can relax a little bit. Give yourself maybe a couple of days, think through it, so that to let your logical side of your brain kick in to see whether this is something that you really want to do, or have you covered all your bases. All right. Then look, try to assess your risks among, the 5 dimensions that I talk about, and see if you can execute the 4 C's, which was suggested by Mr. Crosby. And last but not least, identify yourself among these 5 characters, which is coined by Mr. Freeman Shaw. The reason for you to do this is to identify where your weaknesses are, so that you can improve your execution strategies, so that you can be successful in the stock market and thrive in the long term. So with that, I thank you for your patience. I know it's a dry topic, a little bit over. I'm over time already. Sorry about that, Shane. Over to you.
Thank you so much, David, for sharing with us the psychology and also the relatable examples like hunter, rabbit, assassin, raider, connoisseur, and so that we can relate to our own strengths and weaknesses when it comes to psychological bias in the market. So if you have any questions for David, please write in the Q&A box here. Don't write in the chat box, write in the Q&A box. We have slightly more than 5 minutes for the Q&A.
I don't mind to stay a little bit longer. Sorry about that.
Okay, no problem. So David Yong asks, in this volatile market, should we sell growth stocks and switch to more defensive counters? What is your view on this?
Great question, Mr. David Yong. Okay, so I'm going to frame your question into 2 dimensions. One is for the short term and one for the long term. And I'm speaking purely from my own perspective, from my own point of view, right? On the long term, I am long on technology because of digital transformation that I mentioned, and our livelihood depends more and more on technology and semiconductors. But so as an investment thesis, I'm long on technology. But in the short term, because of rightly what you mentioned, because of the sorry, what did you say again? Sorry, I just want to paraphrase. Volatile market.
Should we sell?
Yes.
Growth stock.
Actually, there is a derating on the high growth stock because of the high interest rate. When interest rate goes up, market tends to be risk off. All right. So which means that there is a derating on the PE multiples. So back in 2020, when the market is flush with liquidity, right? Any growth stock with, that commands a PE of 30, 40, 50 times, even 100 times is justifiable. Why? Because of growth. But at times like this, when interest rates are high, when there are a lot of uncertainties, and when the central banks are trying to reduce the balance sheet exposure, right? There is actually I don't know what's the opposite of premium, but basically it's a concept. Instead of paying a premium for growth, right? Actually, there is a depremiumization on the growth stock, which means that the market, the analysts, and the fund managers tend to put lower PE multiples to this growth stock. So even though the companies, the businesses is business as usual, nothing wrong, all right, orders are coming in, right? Because of this, the devaluation of these PE multiples, it will impact the stock price. So you are right. I tend to I agree with you, and this is what we are doing as well. We are de-emphasizing our focus on high growth stocks, high growth sectors like technology right now, and focus more on value as well as recovery. Thank you for the question.
All right. So the next question is, today we know that the OPR has been risen, right? So
Yep.
the Bank Negara has hiked our interest rate. So the next question by Ricky is, what is your assessment for the banking stocks in Malaysia?
I am probably the worst person to ask this question, Ricky, because I absolutely don't know how to assess banking financial stocks. But that said, I think this OPR hike won't be the last. As long as our Taiko, the US, the Federal Reserves is increasing their interest rate, right? I think all the other central banks in other countries have to follow suit. Otherwise, actually, we are importing inflation from US already. So this is something that I think is gonna. I think this is going to continue. So a lot of people tend to think that this will benefit the banks. I would recommend Ricky to really study, because it may not benefit all the banks depending on what is their business model. All right. I know banking stocks has actually been running out quite a fair bit. Unfortunately, myself and my team really missed this rally. So that's it.
Okay. Yeah, thank you so much for your analysis. That's from Ricky. So I think just now you mentioned about trade to reduce costs. So this is a question by Kelvin. Can you clarify a bit? What do you mean by trade to reduce
Kelvin,
costs?
I highly recommend you to look at one of the webinars under Live Champ, where I talk about how to manage your ABC, which stands for average balance cost. So in a gist, if you are trading in the right direction, meaning if you buy at a lower price and you sell at a higher price, but you don't sell all, the difference, the capital that you recuperate from your sell trade will reduce your balance cost. And this is what I mean by selling to reduce your cost.
Okay.
Right. This is an interesting question by Chua LL.
Okay, you want to take that?
Yes.
Is it advisable for us to keep glove stocks as an investment?
Okay, I'm going to throw the question back to Chua. I cannot advise you anything, but I want you to look back at this slide. Chua, I'm not being cheeky, but I'm just showing you. Hope you can take this constructively. Now, the fact that you are still holding glove stocks, even though, number one, what are the facts? Gloves are very highly cyclical. They operate in a highly cyclical industry. They are facing cost pressure now because of high material cost, because of this high labor cost as well. They are facing competition from China. The demand is actually slowing down because of the pandemic going into endemic. So the shock effect has actually gone already. So ask yourself, what is the reason why you are still holding glove stocks? Is it because you tend to behave like the rabbit in this sense? All right. So please think about the reason why you invested in this in the first place. Has the investment thesis shifted? Has it changed? Has it metastasized into something entirely different from when you first originally invested in the glove industry? Now, I'm not saying that glove industry is totally gone case. Myself and my team are very confident that it will come back again. But at this moment in time, the downside pressure or the risks is actually quite high for us to remain invested in this industry. I'm not pointing to any glove stock. Okay, hope I answered the question diplomatically, Shane.
Okay. Just clarify that none of us here are licensed investment advisor.
Yeah.
All right. So for any professional advice, you should seek your licensed investment advisor. All right.
So got Philip, 2 more questions.
Yeah, Philip Kong asked, can one be a trader and an investor at the same time?
Yes, you can, but try not to mix these two together. Now, what I'm doing, again, I'm human, so I like to trade. I like to have excitement as well. So I've got many portfolios under my name. I've got a few for myself, for my retirement, for my kids. And I've got one particular portfolio just for trading, all right, just for fun. So that portfolio are really for short-term trades, all right. Even some of the stocks that I buy in this portfolio are not fundamentally sound, but just for the fun of it. And the most important thing is, don't put too much money in this kind of portfolio. All right. Say you got 1 million to invest that you want to invest and you want to allocate. So try to avoid putting half into your trading and half into investment. The right thing, the sound thing to do is to put much less into your trading portfolio and much more on your investment portfolio for the long term. So maybe 80-20, or if you're really the risks, if your risk appetite is really huge, maybe you can do 30-70, but I don't think higher than that should be it lah. All right.
Okay, understand your point. Let's do one more question, which is by Feng Yi. From your experience, will the recent Fed action drive the economy into recession or even stagflation?
Okay, to understand the Fed action, right? You got to understand, Feng Yi, you got to understand why the Fed is doing so. Now, in my personal opinion, right, the Fed has got it wrong this time again. In fact, they should have taken action since last year, when the Federal Reserve Chairman, Mr. Jerome Powell, still think the inflation was transitionary, right? In fact, if they started reining in the liquidity then, right, we may not have this kind of shock today, okay? And the reason why they want to do it is because they want to curb the inflation, and because they believe, and by that, hopefully they can solve a lot of issues, the fringe issues like, shortages, so on and so forth. Now you know that wages are all-time high, right? And people are actually choosing what they want to work as. Okay, but the effect of those actions is actually, it could drive the economy into recession. That is a high probability. But don't forget, Feng Yi, that the stock market and the economic health can be dislocated. All right. What I mean is, there is a saying that the stock market looks ahead. So usually the rule of thumb is the stock market is a few months ahead of the economy. So I personally believe that there is a high chance we are heading into recession, but that doesn't mean that the stock market will crash right away. All right. I think it will take some time for the market to digest this. And most of the time, the market will react first. That's why you see when there's a sell down, right, it's very sharp. Then later on, even though the Fed, like what happened the other day was when the Fed announced the 50 basis point increase in interest rate, the stock market in one day really shot up more than 2 or 3%. But of course, after it came down again, but that's beside the point. So what you're saying is actually the side effect of the Fed actions. But instead of looking at the side effect, why don't you put more time to study what they're doing? Is it enough? I personally don't think that managing the interest rate is enough to tackle inflation. We do hope to see more actions being taken, more sound policies being rolled out to tackle inflation over the long term, because whatever it is, whether we are investor or consumer, right, inflation is bad for us. Okay. I'm sorry I cannot answer your question in a more insightful manner because I am not an economist, but I'm purely talking from an investor point of view. So I hope you get my point. Thank you for that question. So
all right. All right. Thank you so much, David, for addressing the questions in our Q&A panel. So the time has run out. So if there's one message that we can take away today, I think don't be a rabbit. That's what we learned.
Yes, don't be a rabbit.
That's all right. So I think just now someone commented that there are a lot of rabbits in the Serba dynamic case.
Oh, definitely. Yeah, we saw a lot of retail went in even at this price. So I mean, they could be right, I could be wrong. I don't know, but it's very high risks.
Yeah, super high risk. All right. So let me take over the screen sharing. Yes. So thank you everybody for attending the session today. All right. So for our next webinar, it is titled Pitfalls and Opportunities in ESG investing. Now, in recent years, I've seen that ESG has become increasingly more important. So in the next webinar, which is happening on 13 May 2022, we are going to have a deep dive into what are the opportunities as well as pitfalls in ESG, like how ESG can cause a price to tank and how ESG can also cause a stock price to rise. So we're going to examine closely into how ESG can influence the investment thesis, okay, or investment merit of a company. All right. So it's happening on 13th of May, this Friday, 8:30 to 10 o'clock. I've given you the registration link in the chat box so you can register for the session. So yeah, please don't miss out this session. I think this session is a very important session for us to gain a better perspective into ESG investing. All right. So with that, a huge shout out to David Paul, who is the founder of Spiral Thinker Group, who helped us to do this segment for us.
Thank you, Chun-Sen. Thank you, Busan, Malaysia.
Yes, thanks everybody for tuning into this session. We'll see you in the next webinar. All right. So bye everybody.
Bye.
Yeah, don't be a rabbit.